Well, let's talk about some non-current assets. So definition of a non-current asset is an asset held for continuing use within the business, not resale. Now, when we say not resale, it doesn't mean you can't dispose and sell your non-current assets. It just means when you purchased it, that wasn't the intention. You were meaning to use these assets continually within your business. So first of all, we have our intangibles. So these are going to be used over a period of time to generate benefits, generate revenues in the income statement, but they have no physical form. So the classics are going to be things like patents, royalties, franchise agreements. But the most common intangible asset that we actually see is goodwill resulting on the acquisition of subsidiaries. And goodwill is going to be the difference between what we pay to acquire a subsidiary and the net assets that we acquire. Again, we're going to look at this in more detail in a later module, so we'll talk about goodwill then. Property, plant and equipment, PP&E, often referred to as being tangible fixed assets because you can touch, feel and stroke these assets if you so wish. So these have physical form. So property is obviously buildings, land, etc. Plant and equipment is machinery, fixtures and fittings, etc. that we're going to use in the production process or retail outlets, whatever. Now the idea is these of course are going to generate benefits over a number of years, so we store the cost in the balance sheet and then release it against earnings in the income statement as we realise those benefits over time. Now we're also, when we look at leases, going to talk about a right of use assets. In the past, when we had a finance lease, and we'll talk about the difference between finance and operating leases when we get to that module much later. But typically when we had finance leases in the past, we used to treat the asset as if we'd bought plant, property and equipment and include it in PP&E. But that changed a couple of years ago. Now, when we acquire an asset, we don't include it in PP&E under a lease. Instead, what we do is we record a right of use asset, which I guess is almost like an intangible asset. Okay, whilst we physically hold the asset, we don't own it. The leasee owns it. So we record a right of use asset because we're entitled to use that asset over the lease period. Now, when we look at leases, we're going to see as well, not only do we record a right of use asset, we're also going to record a liability because, of course, we owe the lessor rental payments on that lease. Investment property, that's an IFRS term. Investment property are land and buildings that you are holding purely for income potential and value appreciation. Okay, US GAAP doesn't have a category for this, so they're just included in your normal plant, property and equipment under US GAAP. But IFRS, we have a separate category for land and buildings that are held for their income potential and value appreciation. Equity accounted investments. Now, we've touched on these before. These are entities where you have influence but not outright control. Okay, and we're going to do something called equity accounting. Now, you don't need to worry about what equity accounting is at level 1, but we're going to dive headlong into it at level 2. All you need to know is they may show up as a non-current asset in our balance sheet. Okay, so equity accounted investments. And we also have equity investments in subsidiaries. Now, I think this is a good time just to talk about company accounts versus group accounts, because I think people get a little bit confused between the two. So, let's talk about company accounts. Let's imagine that I've got a parent company. Here's my parent company, and it's got 3 subsidiaries. Sub 1, Sub 2, Sub 3. Now, in the individual company accounts, the parent will produce an income statement, a balance sheet. Each of the individual subsidiaries will produce accounts as well. And in the parent's accounts, the investments, i.e. what it paid to acquire those subsidiaries, will be recorded at the cash paid to acquire the equity. In other words, the cash paid to acquire the subsidiary. And that's the individual accounts. So if you look at a holding company, a company that really has no commercial activities, it just holds investments in subsidiaries. When you look at the parent company's accounts, the holding company's accounts, all you're going to see is a long list of what it paid to acquire those subsidiaries. But typically when you have a structure like this, and subsidiaries are defined as companies that we control, we're going to have to produce what we call group accounts. Now, what group accounts are going to do, I'm going to just change the colour of my pen for a second. What group accounts are going to do is they're going to take all of these companies and present them as if they were one company. And therefore, we're only ever interested in the shareholders of the parent company. What we're going to do is we're going to compare we're going to take the financial statements of the parent and the subsidiaries and combine them and present them as if they were all one company. What that means essentially is we eliminate the cash paid to acquire each subsidiary, and instead what we're going to do is take the assets and liabilities of each of these subsidiaries, okay, and add them to the parent company's assets and liabilities. Now, by definition, the assets and liabilities in a subsidiary at the date of acquisition, the assets and liabilities compared to the cash paid to acquire the equity, well, the difference is goodwill. So you will see a goodwill figure in the group accounts, but you won't see it in the individual company accounts. So I just wanted to make sure you were comfortable there, or you had a beginning of a working that, yes, in the parent company's accounts, they will show what they paid to acquire the shares in subsidiaries, but in the group accounts we eliminate that, and instead we combine the parent's assets and liabilities with all of the subsidiaries' assets and liabilities to present them as if they were one company, and we only reflect the external shares held in the parent company. Now, I don't want you to get too bogged down in all of this right now. I just want it to be ticking in the back of your mind, okay? Because at times we suddenly touch on things like minority interest or non-controlling interest, and we touch about goodwill, okay, in the level 1 syllabus. And those figures only really appear in the group accounts. They don't appear in the individual company accounts. But where we're really going to go to town on this and actually look at producing group accounts is in the level 2 syllabus. So a lot of this you don't need to worry about quite until we get to level 2. Okay, so that's our subsidiaries. Financial assets, so these would be passively held investments held for more than 1 year. Typically, we're going to talk about under US GAAP. Under US GAAP, what are we going to talk about? We're going to talk about available for sale, and held to maturity. Now, held to maturity, the phrase maturity gives away that this only applies to debt because, of course, equity doesn't have a maturity date. Now, available for sale are speculatively held investments that you may dispose of prior to maturity. IFRS calls these fair value through OCI. So we're going to record the balance sheet value at fair value, okay? IFRS kind of gives that away. And we're going to take changes in fair value through to other comprehensive income. Okay, we'll talk more about these in a later module. Held to maturity, IFRS refers to these as amortized costs investments. It's debt investments which we intend to hold to the maturity of the debt. So passively held debt investments. Again, we're going to touch on these areas in much more detail in a later module. Deferred tax assets, oh goodness gracious me. Look, deferred tax is a complicated area. It's been confusing level 1 candidates for years. We're going to cover it in some detail in a later module. All I want you to take away right now is a deferred tax asset results from me paying more tax now, but less in the future. And because I'm paying less tax in the future, it means less outflows to the company and therefore meets the definition of an asset. We'll cover that in far more detail later on. Let's have a look at some of our current liabilities. So current liabilities that are going to be paid off within 12 months. Trade payables, so these are amounts that we owe our suppliers where we purchase goods on credit, referred to as accounts payable under US GAAP. Short-term financial liabilities, often referred to as notes payable. These are short-term interest-bearing debt instruments. Key point is when you're calculating leverage, you need to include notes payable. Even though they're sitting in current liabilities, there is an interest component to them. And typically our definition of debt is we include all liabilities that are interest-bearing. There is an exception to that, and that is leases, but it makes no sense, and I'll talk about it later. Tax payable is what we owe the tax authorities, or what we think we owe the tax authorities based on this year's earnings. Accrued liabilities is where you've incurred an expense, but you've not yet received an invoice. So it's not sitting there as a payable in any way, shape or form because you haven't received an invoice, but you know you've incurred that expense. Well, accrual says if you know you've incurred the expense, you need to account for it. Okay, a good example of this is on your cell phone, your mobile phone. So you might well pay line rental to your company in advance, so that would be a prepayment, but you don't pay for the calls that you've made until the end of the month. So what companies actually have to do is estimate all of the calls that they've made on cell phones and account for them during the period. Okay, same for things like electricity bills. Company knows it's used electricity, but it might not yet have received an invoice from its electricity supplier. Doesn't matter for the accounts, you still need to include an expense in your income statement estimated at the electricity that you've used. Again, further indication that there's a lot of estimates and judgments passing through that income statement. So accrued liabilities are expenses that we know we've incurred, but we've not yet received any invoice for them, but we need to account for them anyway. Other liabilities, well, we have received an invoice, so maybe, we owe some money to third parties. What kind of things could we have? Maybe wages payable. So we owe our employees and haven't yet paid them their wages, etc. So any other liability that isn't directly related to buying supplies for your company. Unearned revenue is one that the CFA seem to really like, and that is when you've received cash from a customer but have not yet met the criteria to record a sale in the income statement. Okay, so obviously cash is going to go up in the balance sheet, but we can't record a sale in the income statement. So what do we do to keep our double entry bookkeeping working? Well, we record a liability. So let's imagine that a customer has paid us $100, but we've not yet met the criteria to record that as a sale in the income statement. We record a liability for $100. Okay. Now, once we meet the earnings criteria to record it as a sale, we then eliminate the liability and record it as a sale in the income statement. So unearned revenue is typically where you've received cash in advance from customers. Also, of course, in your current liabilities, you're going to see long-term debt due within 1 year. That seems a bit counterintuitive. How is it long-term if it's due within 1 year? Well, if you like, it's formally long-term debt. Imagine you had a bond and you issued it with 10 years to maturity. Well, of course, that bond will be sitting in long-term liabilities every year until we get to year 9. And when we get to year 9, it's then got less than 1 year to maturity, so it gets transferred to current liabilities. Also, with our leases and any amortizing loans, our leases and amortizing loans, we pay a fixed amount, but that fixed amount comprises of interest and principal. Next year's principal flow sits in current liabilities. Principal flows after more than 1 year sit in long-term liabilities. So let's talk about typical non-current liabilities that are going to be paid off after more than 1 year. Well, financial liabilities like loans, and again, of course, loans are often amortizing. You make fixed payments on those loans comprising of interest and principal, meaning next year's principal payment sits in current liabilities. Principal payments falling after more than 1 year will sit in long-term liabilities. Bonds issued, providing, of course, they've got more than 1 year to maturity. Lease liabilities, as we mentioned, exactly the same treatment as loans. They're essentially amortizing. Okay, so we take next year's payment, fixed payment, split it into interest and principal. Next year's principal payment sits in current liabilities. Principal payments after more than 1 year will sit in long-term liabilities. And I will cover that when we look at leases in a later module. Pension provisions. This is in particular defined benefit pensions, where you're promising your employees fixed benefits on their retirement. Okay, so in other words, the pension that we all wish we had, of course, what do we have? Probably defined contribution, where your employer agrees to pay into a fund, and then what that's worth when you retire, quite frankly, is your problem. But with defined benefit, they are promising you fixed payments on retirement. Okay, so they've got a liability because they need to make fixed payments to you on retirement. So what they tend to do is discount those fixed payments on retirement to today's date, okay, and net them against assets, plan assets. Again, I don't want you to worry too much about this, okay? We will see it in detail in a later module when we're looking at leases and pensions, essentially. But we show funded status on the balance sheet, which is the difference between plan assets and the plan liability. And then another word that strikes terror into the heart of level 1 candidates, deferred tax liabilities. All I want you to take away here is deferred tax liability results in you paying less tax today, but more tax in the future. And because you'll be paying more tax in the future, it meets the definition of an outflow of benefit. So it meets the definition of a liability, and that's why we have to record them. Right, let's talk about our equity components. Contributed capital. Now we split our contributed capital between common stock at par and additional paid-in capital. Let's imagine our common stock at par is recorded at $1. That's very common for companies. Not necessary, but common. And let's say the company issues 100 shares for $150. Okay, now what it would do, therefore, is it would record 100 times $1 in its common stock at par, in other words, $100. But if it's issued 100 shares for $150, cash has gone up by $150. So where does the additional $50 go? It goes to additional paid-in capital. Okay, so there you go. So total equity has actually risen by 150, which is the same as the increase in cash to the company. So just be aware that strictly in stockholders' equity, we record common stock at its par value and additional paid-in capital separately. Again, if you're not in the US, you may well refer to additional paid-in capital as the share premium account. It's the same thing. We're also going to see accumulated other comprehensive income items. Now, we talk about them as being accumulated because the balance sheet is cumulative. It builds on year on year on year, unlike the income statement, which resets to 0 at the start of each year. Treasury stock, these appear as a negative item for stockholders' equity. In other words, they reduce stockholders' equity. This is when we have bought back shares. Now, a company can buy back its own shares, okay, and then reissue them at a later date. Whilst it is holding on to those shares, they appear as a negative item in stockholders' equity. Other things worth knowing is when you hold treasury stock, they lose their dividends. Company can't pay a dividend to itself, so they don't get any dividends. And they also, of course, lose their voting rights as well. Again, you don't want the company voting on matters relating to the company. So treasury stock has no votes, no dividends, but it can be reissued or resold at a later date. Retained earnings, of course, that classic figure that is the link between the income statement and the balance sheet, representing earnings that have not been distributed by way of a dividend. And the other thing that we should be aware of is non-controlling interest, otherwise known as minority interest, in our balance sheet. Now, this goes back to that idea that we were talking about showing group accounts. There they were. Remember, we show the accounts, and remember, we show the assets and liabilities of all of the subsidiaries added to the parent company's assets and liabilities. Now, what we actually show is 100% of the subsidiaries' assets and liabilities in the group accounts, even if we don't own 100% of the share capital. And that is because group accounts reflect the assets and liabilities that the company controls rather than the assets and liabilities that the company owns. Now, what that means, therefore, is in the assets and liabilities of the group accounts, we've included assets and liabilities that don't belong to us. They belong to minority shareholders in these subsidiaries. So what we do is we show the net assets, the assets minus liabilities that belong to these minority interests within stockholders' equity. I think it's a bit controversial treating it as a component of equity because, you know, these don't belong to our shareholders. In fact, it used to be that US GAAP treated non-controlling interests as mezzanine finance. So not quite debt, not quite equity. It came as the last kind of balance sheet liability that you saw. And I quite like that idea because it's almost like a perpetual form of debt, isn't it? These are the assets and liabilities that we owe to third parties in subsidiaries that we control, but we're never going to pay that. Okay, it's unlikely it's ever going to be paid. So it's more like mezzanine finance, but it is treated as a component of stockholders' equity. It does mean that the vast majority of analysts remove minority interest, non-controlling interest from stockholders' equity in the group accounts before calculating equity-based ratios because it doesn't belong to our shareholders. Right, let's turn our attention to the income statement. Unlike the balance sheet that builds year on year on year, i.e. all the figures are cumulative, the income statement resets to zero at the beginning of the year. Now, income statement is a US GAAP phrase, but we will typically see that being used by the syllabus. Under IFRS, we're far more likely to use the phrase profit and loss statement or profit and loss account. Notice other names: statement of operations, statement of earnings. So make sure you can feel comfortable using these interchangeably. Now, the balance sheet was a static statement because it was if the company was frozen at a point in time. The income statement is what I like to refer to as dynamic because it spans the period between two balance sheet dates. And what it's going to do is it's going to show the company's performance. Okay, now it's massively affected by the accruals concept. Remember, because we record revenue when it's earned, not when the cash is paid by our customers. We're going to record expenses, first of all, by matching against revenues earned. And if it doesn't match against the revenue earned, we're going to record expenses according to time, allocate them according to time. But it's going to show the performance of the company because what it's going to do is it's going to show you your revenue, okay? And our revenue is going to be, obviously, our net revenue. And this confuses people because in the syllabus, sometimes it says revenue, sometimes it says sales, sometimes it says turnover, okay? But actually always we're looking at net revenue, which is the sales figure net of warranty provisions that we've had to estimate at the time of sale, net of things like prompt payment discounts as well. Again, we'll touch on that later on. So our revenues are sales of our primary goods and services. Other income, well, other income is any income that we generate that is not directly related to our primary business operations. So let's imagine that I'm a training company like Kaplanlearn, for example. So my major activities is selling books, providing training courses, etc. But I happen to have a building that I'm not using and I rent it out to a third party. Now that rental income I'm receiving would be treated as other income because it is not part of my core business operations. So other income is going to be therefore any income you generate that is not part of your day-to-day business operations. Subjectivity comes in here. What is part of day-to-day operations? What isn't part of day-to-day operations? Going to vary from company to company. And we're also going to show gains. Gains are typically values that we create when we dispose of assets. If you dispose of assets and you get more proceeds than the balance sheet carrying value of the asset at the date of disposal, you record a gain in the income statement. They can also relate to liabilities, retiring liabilities early. Again, if you can retire a liability early and pay less than the balance sheet carrying value of that liability, you record a gain. Okay, and our expenses, well, of course, our expenses are going to be linked to producing our goods and services, which we're often going to refer to costs of goods sold. And they're also going to have expenses that are due to the day-to-day running of the company, which we're going to refer to often as sales, general and admin. We also might make losses, again, when we dispose of an asset. So if you dispose of an asset and the proceeds you receive are less than that asset's carrying value, remember, just means balance sheet value, you're going to get a loss. Likewise, if you retire a liability early and you have to pay more than the carrying value of that liability, again, you get a loss. So we're going to take all of the revenues that are generated in the period minus all of the expenses that are generated in the period, and that gives us our earnings, our net income or our net profit. What is the period? Well, the period is always the period between two balance sheet dates. Okay, so certain things have to be shown on the face of the income statement. We need to show our net revenue, operating costs. Now, operating costs essentially are things like, get my pen working again. Operating costs are things like our cost of goods sold and our sales, general and admin. Okay, so costs of producing your goods and services and costs relating to actually running the company. Now, notice they can be combined and treated as one line, operating costs. That is known as a one-step income statement if a company takes those two figures and combines them and shows just one figure, operating costs on the, or operating expenses on the face of the income statement. Okay, and notice that's actually all IFRS and US GAAP require. So you can amalgamate these two figures and produce a one-step income statement. But there is such thing as a multi-step income statement where these figures are shown separately on the face of the income statement. So a company can choose to show its cost of goods sold figure separately and its sales, general and admin figure separately, in which case you typically see a gross profit line in a multi-step income statement. It's down to the company. Now, what you should be aware of is if they do decide to aggregate the cost of goods sold and the sales, general and admin, they would have to give you the split of them in the footnotes. Okay, so it's perfectly possible to take a one-step income statement and produce, as an analyst, a two-step income statement if you want to identify things like the gross profit margin. And if you're an analyst, you really do want to be analysing gross profit lines or gross profit margins, essentially on a product-by-product basis. Finance costs, these are not part of operating your business. Typically, these are interest costs. Now, we take our interest costs and we say, well, that's not part of your operations. Your operations are all to do with the goods and services that you produce, sell, run in the company. Your finance costs results in how you finance those operations. So we split them out separately. So this is typically our interest. And notice again, required separate presentation, the tax expense. Okay, now IFRS, this is IFRS's last couple of bullet points down here. Either you can group expenses by nature, i.e. wages, depreciation, etc., or you can group by function, cost of goods sold, sales, general admin, R&D. Okay, what we're typically going to see throughout the CFA syllabus is groupings by function, because that is common to both US GAAP and IFRS. Even when you look at IFRS, whilst they allow companies to group by nature, it's rare. It only really is done by smaller companies. It's only done by companies where it makes some kind of sense to split out the nature of each expense separately. So pretty rare. Here is a multi-step income statement just to give you an idea of what they look like. So we show the net revenue in the period. Okay, so that is our gross revenue, our sales figure, minus warranty provisions, minus discounts that we offer customers, etc. We then subtract the cost of goods sold. So this is multi-step, remember. Okay, so we show cost of goods sold separately. And that cost of goods sold, remember, is applying the matching concept. So the cost of goods sold actually represents the number of units that we've physically sold during the year. That takes us down to our gross profit margin or gross profit line. We can then deduct our sales, general and admin expenses. SG&A tends to be a US phrase. IFRS doesn't tend to use that phrase, but nonetheless is going to show the operating expenses after gross profit. Notice we've got research and development separately here because, again, this is, going back to the previous slide, grouping by function. So we're going to show our research and development expenditure separately here, coming down to our operating profit. Then any other income and revenues is shown separately. So these are other income, any income that is not related to your day-to-day operations. Okay, so it could be maybe I've received dividends on an investment, but I'm not an investment company. I'm not a fund of any type. So again, it's sundry. It's not part of my day-to-day business operations. Or that example where I have a building I'm not using, so I lease it out to a third party. Well, again, my business is not to be a property company. It's not to receive rent, essentially. So that would be incidental to my core operations, so it would be shown separately. Financing costs is typically the interest that we pay on our debt securities. So it's a function of the capital structure of the company, the blend of debt to equity that we use. So it's going to be our interest figure there. And then notice we have unusual or infrequent items. We'll talk more about these in a module later on. But these are items, and the clue is in the name, that are either unusual, so really strange, or very rare. Okay. Now, what we believe here is they're so strange and odd, these items, that we need to bring them to the attention of the users of the account. So we're going to show them separately on the face of the income statement. So by definition, these are going to be material items. It could be a massive impairment of an asset, something like a goodwill write-off. It could be that maybe one of our product lines has gone insolvent and we need to write off the value of the inventory that we hold for it. Okay, so these are big one-off items. Now, the issue for the analyst is, are these operating items? Are they not? Should I include them when I'm forecasting future operating profit? Should I exclude them? Because it's amazing how many companies have repetitive, unusual or infrequent items that seem to appear year after year after year. Classic one being restructuring costs. So again, area of subjectivity for the analyst. That brings us down to our income before tax, often referred to as earnings before tax. So we then have our provision for income taxes. It's an estimate, hence that word provision, because what you do is you look at the profit this year, you look at what you think is your taxable profit the year, and you work out taxable income. Okay, then you apply the statutory tax rate to that, and that is what you think you owe the tax authorities. You think you owe the tax authorities, but you're not sure, because actually working out how much you're going to pay to the tax authorities is a bit more of art rather than science. You might know this if you've ever tried to do your own tax return. What you think you owe and what they tell you you owe never seem to reconcile perfectly. And it's exactly the same for companies. You know, what items can be tax deductible? What items are not tax deductible? So number one, it's our estimate of what we call tax payable. Okay, so it's our estimate of tax payable, but it's not just that. To get you very confused. So our estimate of tax payable is done by taking our taxable income, which we think is our taxable profits, because taxable profits are not the same as accounting profits, as we will see later, times our tax rate. I'll keep my pen down or it'll appear in the camera at the top of the screen. So taxable income times tax rate gives us our expected tax payable, but then what we're going to add on is change in deferred tax liabilities. Okay, and we're going to subtract change in deferred tax assets. I don't want you to get too worried about this right now. All I want you to be aware of at this point is when you look at income taxes, you are not simply seeing the amount that you think you owe the tax authorities. It is more complicated than that due to deferred tax liabilities and deferred tax assets. Notice that gives us our income from continuing operations, known as the line. Everything above the line is shown gross, and the tax is included in our provision for income tax. Anything below the line is shown net of tax. So notice what we've got there, plus or minus income from discontinued operations. Now this is not, what is a discontinued operation? It's an operation that you've shut down or disposed of, either midway through the year, or you shut it down and you're going to dispose of it in the subsequent period. But you've made the decision that you're going to shut down this division. Now, all of the gains and losses we make as we dispose of its assets individually, if we're going to sell off its assets piecemeal, or if we sell off its equity, the gain or loss we make on its equity, that's actually shown in the unusual or infrequent items line. So if the gains or losses on asset disposal or equity sale is in the unusual or infrequent line, what is the income from discontinued operations? Well, essentially, what this is the operating results of that disposed division up until the point of disposal. So let's imagine that we disposed of a division 3 months, after 3 months of the year. So what that means is we've got 3 months of its revenues, 3 months of its cost of goods sold, 3 months of its expenses, etc., 3 months of its net income. But the issue is that's not going to be repeated in future periods. So we don't want to include it in the company's revenue, cost of goods sold, sales, general admin, etc. Instead, we're going to show the results from those discontinued operations here in this separate line. Why? So that analysts don't build these results into their forecasts of future operations. Now, as a result, it's an item that could be abused, discontinued operations, because we could take some continuing operating expenses and try and hide them in this line. So again, an analyst needs to be, I'm not going to say suspicious, but needs to make sure that income from discontinued operations makes sense and can be verified. The other thing we're going to see here is the share from profit of associates. So remember, these associates, we're going to really discover equity accounting of associates in level 2. Okay, but I want you to know that the share of profit from associates appears here after the tax line. What it's actually, or the way we're going to calculate it, which we'll see at level 2, is we're just going to look at the earnings of the associated company, affiliated company. If we own 20% of it, we'll take 20% of its earnings and build them into our income statement. And then the final thing, notice we're deducting, is the non-controlling interest. Now again, this you're only going to see in group accounts. And it goes back, I talked about in the balance sheet, when we have subsidiaries and produce the group accounts, we reflect the assets and liabilities of those subsidiaries. Well, in our income statement, what we're going to do is we're going to show all of the revenues and expenses, i.e. all of the earnings of those subsidiaries added together and combined with the parent company. And we show 100% of the revenues and expenses of the subsidiaries, even if we don't own 100% of the share capital. And again, that's because in the balance sheet, we bring in 100% of the assets and liabilities. We reflect the assets and liabilities we control. So in the income statement, we need to reflect the revenues and income from those revenues and expenses from those controlled assets. But ultimately, that means we're bringing in earnings that don't belong to our shareholders, earnings that belong to the minority interests. So we have this little line minus non-controlling interest that just removes the earnings that didn't belong to our shareholders, that belong to the minority, in arriving at net income, which is referred to as the bottom line. Well, we've touched on this already, non-operating items. So in particular, I'm looking at interest, dividends, gains and losses on disposal of investments. Are those operating items? Are they non-operating items? Well, the ultimate decision is with the company when they're producing their accounts and the analyst when interpreting their accounts. Because, of course, if I'm a financial service company, a bank, an investment fund, receiving interest, receiving dividends, making gains and losses on investments as I trade them is part of my day-to-day operating activities. So I would expect to see these items included in operating activities. If I was a bank, for example, receiving interest on amounts that I've loaned now is part of my core operations. Okay, it's the first figure, isn't it? It's essentially the turnover of the bank. So I'd treat those as operating activities. But if I'm looking at a non-financial service company, a company like Kaplanlearn, these are not part of the core day-to-day operations. We are an education and training provider, ultimately. So I'd treat them as non-operating income or other income. So what we're saying here is there's subjectivity in the income statement about how items are treated. Again, it comes down to the company because the ultimate responsibility of producing the accounts lies with the managers or directors of the company. And then it comes down to the analysts in whether they believe that is an accurate representation of the true revenues, expenses, etc. of the company. So be careful is what we're saying here. Subjectivity goes on in the accounts. Again, people tend to think that the income statement, the profit and loss account, is correct down to the nearest £1 or $1. Reality is there's huge amounts of estimates, assumptions due to the accruals effect that mean essentially there's subjectivity. Now let's just talk about that link between the balance sheet and the income statement briefly. Now the link between the balance sheet and the income statement is retained earnings. It's a component of your stockholders' equity. And note it reflects the cumulative profits retained in the company. And when we say retained in the company, we're simply meaning not paid out by way of a dividend. So what you've got here is a little reconciliation of retained earnings. So retained earnings in last year's balance sheet, so that was just simply last year's balance sheet, we've got 200 million. This year, the company generated net income of 80 million and declared a dividend of 20 million. So notice the retained earnings go up by the retained profit for the year. And the retained profit for the year, of course, is the net of the 80/20. So the retained profit is 60. Now, what it means, because you've got this net income figure affecting retained earnings, anything that affects the income statement by default is going to affect the year-end retained earnings figure. And that is your linkage. It means anything affecting the income statement also affects the balance sheet. Well, I've got a little example here. It's got debits and credits in it. Don't freak out. You're not going to be doing debits and credits in the exam. Okay, I just put them in. I don't know why I put them in here. Maybe I shouldn't. Okay, so look, inventory that had cost us 20 million was sold on credit for 30 million. Let's have a look at the transaction treatment of this. Well, if I've sold 20 million of inventory, I'm going to need to remove that from my income statement. So I'm going to lower my inventory by 20 million. That's going to be a reduction in an asset. And I'm going to transfer that to the income statement because I've now sold this inventory. But I've also sold it for 30 million on credit. Okay, so I'm going to record a sale of 30 million in the income statement, and I'm going to record an asset of 30 million in the balance sheet, being the cash I'm expecting to receive from my customer. So let's have a look at assets. Assets here. The inventory goes down by 20 million because I've sold off that inventory, but because I've sold it for 30 million on credit, an accounts receivable asset appears for 30 million, so my net assets have increased by 10 million. Now, if my net assets have increased by 10 million, either liabilities or equity also need to increase by 10 million, or my accounts are not going to balance. Now, as it happens in this case, it's going to be equity via retained earnings. Why? Well, because of course the other side of these transactions are in the income statement. I've got a sale of 30 million. Okay, cost of goods sold is the cost of the inventory I've sold, 20 million, meaning my net income goes up by 10 million. And if my net income goes up by 10 million, my retained earnings goes up by 10 million. And if my retained earnings go up by 10 million, so too does stockholders' equity. So in fact, the net overall impact of this is assets increase by 10 million, equity increases by 10 million. It's a nice little illustration as well of why double entry bookkeeping keeps that balance sheet equation always balancing. Or as we say in the world of bookkeeping, the total value of the debits has got to equal the total value of the credits. That is, the total value of our debits was 50 million, the total value of our credits was 50 million. Okay. Now, 90 days later, the customer settles their debt. Now, what we're going to see here is there is no impact on equity here when they settle their debt because of the accruals process, because we recorded the sale not when the customer paid us, we recorded the sales when the earnings were complete. In other words, when the goods were transferred to the customer. So when the customer actually pays us 90 days later, all we're going to do is increase our balance sheet cash by 30 million and eliminate the accounts receivable by 30 million, which of course means assets overall. Yes, the composition of assets has changed because we've now got more cash and less accounts receivable, but overall the change is zero. Right, comprehensive income or statement of comprehensive income. Not all gains and losses pass through the income statement. Okay, some can get taken directly into stockholders' equity and they get included in what we call accumulated other comprehensive income. So this is an accumulation of unrealized gains and losses that have never gone to the income statement. Why, you might ask? Well, now's not the time to be asking that question. We will see it gradually at level 1 and level 2. You just need to take away that some gains and losses do not hit the income statement and instead can be taken directly to stockholders' equity. Now, of course, what that means is if you look at the income statement, you're not seeing all of the gains and losses that the company made. You're not seeing the entire earnings. Now, income, earnings, use them interchangeably. Earnings tends to be, again, more outside the US. Income tends to be a more US phrase, but income, net profit, earnings, all the same thing for your exam. Okay, so if you look at net income in your income statement, you're not seeing all of the gains and losses that have been generated for your shareholders. As a result, both US GAAP and IFRS require a statement of comprehensive income. This is the total gains and losses generated. Now, it can either be one statement, which means added to the end of the income statement, or shown separately as two statements. So one statement, you have your income statement ending at net income, and then another financial statement that shows comprehensive income. Most companies show them as two, but you don't necessarily have to. Now, what are these gains and losses that can be taken directly into stockholders' equity? Well, with defined benefit pension plans, they are known as remeasurements. Under IFRS, they're known as actuarial gains and losses under US GAAP. These are changes in the pension liability as a result of actuaries changing their assumptions that are used to calculate the pension liability. Again, don't worry about it right now. We will have a little look at defined benefit pension plans at level 1 later on, and we're going to dive headlong into them at level 2. Other one is cumulative translation adjustments. These are to do with converting overseas subsidiaries back to your reporting currency at year end. We're going to see again at level 2, so you don't need to worry about this now. There are two methods. One is known as the temporal method, or temporal method. I'm never sure quite how you pronounce it. The temporal method, where gains and losses caused by exchange rate movements when you convert an overseas subsidiary's balance sheet and income statement to your reporting currency, hit the income statement. And the other method is the all current rate method that treats essentially the investment overseas as an investment and takes the unrealized gains and losses caused by currency movements direct to stockholders' equity. Again, don't worry about this. Just be aware, cumulative translation adjustments, something to do with converting the financial statements back to my reporting currency to produce the group accounts at year end, okay, for overseas subsidiaries. So my parent company's in the US, my overseas subsidiaries in the UK. I got to convert that balance sheet, the UK company's balance sheet, into dollars. I'm using the all current rate method, okay, and it results in something called a cumulative translation adjustment. We will look at them at level 2. Cash flow hedges is where I'm hedging purchases or sales using derivatives, and the unrealized gain or loss on the derivative is held in stockholders' equity until I make the purchase or sale, and then I will release it and match against the purchase or sale in the income statement. Again, don't really need to worry too much about this. We'll talk a little bit about cash flow hedges in level 1 derivatives, but you never really need to worry about the accounting treatment, but just be aware the unrealized gain or loss on the derivative is held in stockholders' equity. Now the next one, unrealized gains and losses on available for sale securities, what IFRS refers to as fair value through other comprehensive income, is one that we actually see in the level 1 syllabus. The idea is if you have an available for sale security, that's the US GAAP phrase, fair value through other comprehensive income, IFRS phrase, then you record the balance sheet asset or asset at fair value. Now, of course, fair value is going to change over time, and these changes in the fair value are not taken to the income statement as gains and losses. Instead, they're taken directly into stockholders' equity within our other comprehensive income. Also, again, one that is mentioned briefly in the prerequisites but isn't in the main syllabus anymore is under IFRS. When you revalue your PP&E and intangibles, and remember, under IFRS, you've got a choice. You can choose to revalue PP&E and intangibles. And you can choose to revalue each individual class of PP&E and intangibles. So, for example, I might choose, I'll revalue my land and buildings, but I won't revalue fixtures and fittings each year. So you get a choice of using revaluation or historic cost methods, depending on the asset's class. But once you do choose revaluation under IFRS for a particular class of assets, then you do have to be consistent year on year. Now, revaluation means rather than recording the long-lived asset at historic cost less accumulated depreciation or amortization, we're going to record it at fair value. Okay, and therefore these changes in fair value are going to result in unrealized gains and losses, and they are taken through to stockholders' equity just like the available for sale securities under US GAAP. Again, useful background knowledge, but you shouldn't be tested on that point specifically because it's in the prerequisites and not the main syllabus. Here is our comprehensive income statement. Now notice it starts off with net income from the income statement. So this is when we're showing two separate statements. So we're showing the income statement separately and then we're tagging on, then we're producing a separate statement for comprehensive income. Remember, as I said, you can get to net income in the income statement and then continue on to comprehensive income and present them as one statement. Okay, in other words, only produce the comprehensive income statement. Most companies show both. Okay, so we've shown our net income statement. Now we're showing the comprehensive income statement. So the very first line is the net income from the income statement. What we're then going to do is then look at all of those items included in accumulated other comprehensive income. But we have to be careful here. Okay, because the balance sheet is cumulative. We want this year's gain or loss, which means we need to look at the change in each of these other comprehensive income items. So it's not the foreign currency translation adjustment sitting in the balance sheet at year end. It's the change in the foreign currency translation adjustment from last year to this year. Okay, same for, things like unrealized gains and losses on available for sale securities. You will be seeing the accumulated gain since that security was purchased in OCI. But what we want in here is the change this year. Okay, so it's always the change in the balance sheet item. Be careful with that. It's not the item sitting in the balance sheet at year end. It's the change between last year's balance sheet and this year's balance sheet. So we're going to look at that for all of the other comprehensive income items to get a comprehensive income figure. Now, cash flow statement, as we mentioned, the income statement, because of the accruals concept, is not the same as cash generated for the company. So we also produce what is called the cash flow statement. It's a dynamic statement just like the income statement, and it spans, of course, the same time, i.e. the period between two balance sheets. And what it's trying to do is show how the company generated and spent cash. Now, of course, the difference between the company, the cash that the company generated and the cash the company spent should be the change in the balance sheet cash figure. In other words, last year's balance sheet cash figure compared to this year's balance sheet cash figure. So that's all we're doing, is we're showing how the cash changed, okay? And we're going to split it down into three different areas: cash flow from operations, cash flow from investing, and cash flow from financing. Now, cash flow from operations, we typically call it CFO, but it can be called OCF, operating cash flows, and the examiner likes to use them interchangeably. Typically, 90% of the readings, it'll mention CFO, and then suddenly it'll throw OCF at you. And candidates freak out thinking, I don't know what OCF is. Well, it's just CFO under another name. So just watch out for that one. Now, CFO is typically the cash that the company generates from its day-to-day core activities. Okay. CFI is cash flow from investing. So it's the cash that the company spends on PP&E, intangibles, investments, and of course the cash that the company raises if they dispose of any of those. And then finally, cash flow from financing is really looking at capital structure. So cash raised when we issue new debt or when we issue new equity, cash received, cash paid when we issue new, let me start that again. Cash received when we issue equity or we issue new debt. Cash paid when, of course, we're paying off the principal on debt or redeeming equity. Now, again, there's a little bit more subtlety to those three classifications that I'm letting on there, but we shall see that when we look at our cash flow module a little bit later. And notice, CFO plus CFI plus CFF gives us the change in balance sheet cash. Change in balance sheet cash, add it to last year's balance sheet cash figure, and you should get this year's balance sheet cash figure. And we will be doing that in anger in our cash flow module a little later. Right, our final statement, and that is the statement of stockholders' equity. It is just a reconciliation of this year's stockholders' equity and last year's stockholder equity. So what did we say were the components of stockholders' equity? The contributed capital, which is the common stock and additional paid-in capital. Preference stock or preferred stock, if you have any of those. Pretty rare these days to see preferred stock. Be aware of it. What is a preference share? It's a share that typically doesn't have voting rights but pays a fixed dividend. And I think the one thing you must know regarding preference shares is their dividend has to be paid before you pay the dividends on common stock. Okay, that'll come into effect when we look at earnings per share computations in Module 3. So you've got preferred stock, common stock, additional paid-in capital. Those three together are our contributed capital. Okay, you can see we've got some stock-based compensation adjustment in our additional paid-in capital. That must be to do with either stock grants to our employees or stock options. We will look at that later. We've also got, you can see, a stock issue. So the company's issued some more stock, okay, and must have issued it for, I assume these figures are in millions, let's assume. Must have issued for 60 million, okay. 10 million going to common stock at par, and the additional 50 million going to additional paid-in capital. Then we've got our retained earnings figure, and remember that, of course, is the linkage between the income statement and the balance sheet. So you can see last year's retained earnings. Net income, 200 million. That should agree to the figure that's sitting at the bottom of your income statement, okay, your profit and loss account. There's the dividends, 60 million, okay, that they've decided to pay out this year. Okay, so if they hadn't paid any dividends, retained earnings at year end would be 840, but because of that dividends of 60, retained earnings at year end 780. Treasury stock we've got going on there as well. So this company has bought back some shares. You can see it's currently, at the beginning of the year, it held 50 million. You can see it's in brackets here, indicating that it reduces your stockholders' equity. But they repurchased a further 10 million shares. And remember, those shares sit with the company and can be reissued at a later date. But whilst they're sitting with the company, no votes, no dividends. We've then got our accumulated other comprehensive income. It looked like an overall accumulated gains of 200 million at the beginning of the year. But you can see this year, okay, we've got an OCI net loss. Okay, just going to flick back a couple of slides. Okay, there you go. That means these items were a net loss in aggregate of 50 million. In fact, you could do your comprehensive income statement, couldn't you, here? What was our net income? Our net income was 200 million. And then we got a loss of 50. So our comprehensive income for this company would have been 150 million for the year. So there's your accumulated other comprehensive income, net loss. So it means accumulated other comprehensive income at the end of the year was 150. And notice the last line we've got in here is a non-controlling interest. Remember what that means. It means that essentially assets and liabilities included in our balance sheet, or net assets, I should say, really, assets minus liabilities that are included in our balance sheet, totaled 50 million at the beginning of the year and 60 million at the end of the year. In other words, in our balance sheet, net assets, 60 million of those net assets do not belong to our stockholders. Okay, and that's the statement of stockholders' equity. Okay, so I think you need these understandings before you dive into the learning modules or the learning outcome statements you can be tested on. I'll see you shortly for the first module on actual exam testable information. Thank you very much for listening.